All right, welcome in everyone to another episode of Four Quarters and 10K. I'm Steve.
And I'm Evie.
And today we're embarking on what we call around here a deep dive. We've got the 10Qs, we've got the 10K, and we're going to be going over all that good stuff. But first, we always like to just take a step back, zoom out a little bit, and just kind of paint a picture of what this company actually does.
Yeah, especially with a company like Disney that, everybody kind of has an idea of, Mickey Mouse, the parks, but there's so much more to it. So let's kind of lay the groundwork here.
Yeah, I mean, right off the bat, when I think of Disney, it's like a global powerhouse. I mean, they're in entertainment, they're in sports, those experiences, the theme parks, the cruises, everything. I mean, it's pretty impressive.
Yeah, it's a truly diversified business model, and it's been really interesting to see how they've been performing, especially lately. I mean, you see the revenue growth, particularly in, some of their key segments. And what's really exciting for a lot of investors is that profitability in their streaming services is, finally starting to, pick up and head in the right direction.
Yeah, and, you talk about all these different segments and everything, but you can't really talk about Disney without talking about the brand.
Yeah.
Right. I mean, it's more than just a name. It's an emotional connection for people. And that brand strength, along with, just their catalog of, characters and stories, their IP, that's a huge competitive advantage, and it really sets them apart from so many other companies.
Yeah, it's hard to overstate how important that brand is. And they've done a really good job of, not just resting on that, but using it to fuel their growth, especially in the streaming space. You think about the full acquisition of Hulu, and then you look at some of these other moves they're making, like, the investment in Epic Games, and it shows that they're really thinking about the future of entertainment and where they fit in.
Yeah, it's really interesting to see how they're kind of navigating this shift in how people consume entertainment. On the one hand, you've got the traditional TV networks that are facing all these challenges with cord cutting and people moving away from cable, but then you look at the big picture, and it seems like they're really well positioned to, not just survive, but really thrive in this new environment.
Yeah, absolutely. It's all about adapting and evolving.
So let's rewind a little bit. I mean, Disney, as we know it today, it didn't just magically appear, right? They have a long history.
Yeah. Oh, absolutely. I mean, we're talking about a company that started as a small animation studio decades ago and has just transformed into this global entertainment and media behemoth. And, that history is really important because it's what built that brand recognition, those beloved characters, the stories. It's a foundation that very few companies can match.
Okay, so, fast forward to today, how is this massive organization actually structured? I mean, if you were to draw it out on a whiteboard, what are the main divisions?
Well, as of fiscal year 2023, Disney primarily operates through three kind of core business segments: entertainment, sports, and experiences. And each of these segments plays a really distinct role in the overall Disney ecosystem and contributes to their financial success in different ways.
All right, so let's break those down one by one. Starting with entertainment. I mean, that's probably what comes to mind first for most people when they think of Disney, the movies, the shows, all that good stuff.
Right, exactly. The entertainment segment is really the heart of their content creation and distribution. They're producing stories and programs across, a whole bunch of different platforms. And within that segment, we've got a few subsegments. So, first up, you have the linear networks. These are those traditional cable channels that, many of us are familiar with: Disney Channel, ESPN, Freeform, FX, National Geographic. And these networks, they make money through a couple of main ways. First, they get affiliate fees. So that's basically the money that cable and satellite TV providers pay to Disney to carry their channels. And then, of course, there's advertising revenue.
All right, so those are the channels that, have been around for a while. What's the next piece of the entertainment puzzle?
Well, then you've got direct-to-consumer, and this is where the streaming services live. So, this is Disney plus Hulu, ESPN plus soon. This has been a huge focus for Disney, and for good reason, because this is where a lot of the growth in entertainment is happening, with people moving away from traditional cable and towards these streaming platforms.
Yeah, makes sense. Everyone's cutting the cord these days.
Yeah.
So what's the last part of the entertainment segment?
Okay, so that's content sales licensing and other. And this is basically how Disney makes money from their content beyond their own platforms. So think about things like, movies being released in theaters, then they become available for, digital purchase or rental, or they license their content to other streaming services or TV networks. And of course, you can't forget about the merchandise, licensing their characters and brands for, all kinds of products, that's huge for them.
Yeah, I mean, that's everywhere. It's like you walk into any store and you see Disney stuff. All right, so we've covered the creation and distribution of their entertainment content. Now let's move on to sports.
When I think Disney and sports, I think ESPN. Yeah, you're not alone there. The sports segment is really centered around ESPN and all the assets that come with it. They're a dominant force in sports broadcasting with live games, analysis, sports news, and they deliver that content through their cable networks and their streaming service, ESPN+. So it's a really important part of their overall portfolio, and it gives them a way to reach a whole different audience, but an audience that's just as passionate.
Yes, sports fans are definitely a dedicated bunch. Now, the last big segment we have is experiences. And I think this is where the Disney magic really comes to life in a tangible way, right?
Yeah.
You're actually going there, you're experiencing it.
Yeah, exactly. The experiences segment is all about Disney's in-person interactions with consumers. And the most iconic part of this, of course, is their theme parks and resorts. I mean, you've got Disneyland in California, Walt Disney World in Florida, Disneyland Paris, Hong Kong Disneyland, Shanghai Disney Resort, and Tokyo Disney Resort. It's a global empire of theme parks.
It's incredible how far they've expanded their physical footprint. What else falls under that experiences umbrella?
Well, you've also got the Disney Cruise Line, which is another way for them to offer, unique and immersive vacation experiences, but this time at sea. And then beyond the big attractions, the experiences segment also handles all their merchandise, like everything from those Mickey Mouse ears you see at the parks to, toys and clothes that are sold all over the world. They design it, they source it, they sell it. It's a massive operation.
So you really see how all these different segments work together.
Yeah.
You have a hit movie that comes out, then maybe that inspires a new ride at a theme park. And then, of course, people want to buy the merchandise, to remember the experience.
Exactly. It's a perfect example of the synergy between those different segments. The success of their content in the entertainment segment can directly drive people to spend money in the experiences segment. And it all comes back to the power of their intellectual property. It's like this amazing cycle that feeds itself.
So we've got a good understanding of how Disney is structured, but let's talk about the money now. How does this massive machine actually generate revenue?
Well, Disney has a really diversified revenue model, so they're pulling in income from a bunch of different sources that align with each of those segments we just talked about. And that diversification is a big part of what makes them so financially stable and resilient.
Okay, so how have they been doing financially recently? What are the numbers telling us?
Well, if we look at their recent performance, particularly Q1 of fiscal year 2025, and then also the full fiscal year 2024, we can see some pretty interesting trends. So in Q1 2025, they reported a 5% increase in their overall revenue, hitting $23.5 billion compared to $22.5 billion in the same period of the previous year. So that's $1 billion increase, which is pretty substantial, showing just how much revenue they're generating.
Wow, that's impressive. What about their profitability during that same period?
Well, their operating income also saw a pretty big jump in Q1 2025. It climbed to $5.1 billion, which is a good sign because it means that, they're not just bringing in more revenue, but they're also getting better at converting that revenue into profit, which is what investors want to see.
All right, so let's break down that revenue growth by segment for the first quarter. Where did they see the biggest gains?
So the entertainment segment brought in $10.872 billion with a solid 9% increase. Then you had sports, which was pretty flat at $4.850 billion. And then the experiences segment also performed really well, hitting $9.415 billion in revenue, which was another 9% increase. So entertainment and experiences were the big drivers of growth in that first quarter.
Interesting. So they saw strength in both their content and those real-world experiences. Now, within the entertainment segment itself, we talked about linear networks, direct-to-consumer, and content sales licensing. How did those different parts of the business perform?
Right. Well, within entertainment, it was a bit of a mixed bag, reflecting, some of the bigger changes happening in the media landscape. Linear networks saw a 7% decrease in revenue, which really highlights how cord cutting is impacting their traditional cable business. But on the flip side, direct-to-consumer was a bright spot with a strong 13% increase, bringing in $6.072 billion. And then content sales, licensing, and other actually saw a pretty dramatic jump, up 34% to $2 billion. Now, there could be a few reasons for that. Maybe they had some really successful theatrical releases, or maybe there's just increased demand for their content on other platforms.
Yeah, it's interesting to see that, that growth in streaming really seems to be taking off for them. And that increase in content sales and licensing is definitely something to watch. Okay, what about the experiences segment in Q1 2025? I know we talked about the 9% overall increase, but what was driving that?
Well, if we look specifically at the domestic parks, they saw a modest 2% increase in revenue. But interestingly, their operating income actually decreased by 8%. Now, this was largely attributed to some unusual events, specifically the impact of hurricanes, which, likely affected park attendants and just caused some operational disruptions. And then there were also some pre-opening expenses associated with their new cruise ship, the Disney Treasure.
Okay, so it sounds like, those were probably isolated factors rather than a sign of some broader trend in the domestic parks. What about the international parks? How did they perform?
The international parks actually did really well, with a 12% increase in revenue and a pretty impressive 28% jump in operating income. So that really shows the strong demand for Disney's theme park experiences outside of the U.S., and it suggests that their international expansion strategy is really paying off.
All right, so that gives us a pretty good snapshot of the first quarter of fiscal year 2025. What about the bigger picture? For the full fiscal year 2024, how do the different segments compare?
For the full fiscal year 2024, the entertainment segment was the biggest revenue generator, pulling in over $41 billion. Experiences came in second, generating almost $34.2 billion, and then sports contributed a solid $17.6 billion. So while entertainment is still the leader in terms of revenue, experiences is a close second and definitely a significant contributor.
So content might be king, but those immersive experiences are a close second. Now, when we look at this financial data across both the quarterly and the annual reports, what are the key takeaways? What are the big trends that jump out?
I think there are a few really important trends that emerge. First, that decline in linear networks revenue. That's a clear reflection of how people are shifting away from traditional cable TV, and that's a trend that's likely to continue. But on the positive side, the strong performance of the direct-to-consumer subsegment shows that Disney's streaming strategy is working. They're gaining subscribers, and they're exploring new ways to make money from those streaming platforms, like with advertising. The consistent strength of the international parks is also really noteworthy, showing that there's strong global demand for those experiences. And then finally, it's just important to remember that, sometimes you see these fluctuations in operating income, like with the domestic parks this quarter, and it can be because of these specific, sometimes unpredictable events.
Okay, so we've got a good handle on how Disney is structured, how they're performing financially. Now let's get a little more strategic. Let's do a SWOT analysis. Strengths, weaknesses, opportunities, threats. So starting with their strengths, what are the core advantages that Disney brings to the table?
All right, well, Disney has some pretty significant strengths. First and foremost, I would say, is their brand recognition and loyalty. I mean, the Disney brand evokes so many positive emotions for people, and that creates a level of customer loyalty that's really hard to find. And it's not just, kids or families, it spans generations.
Yeah, their brand equity is incredible. What else makes them so strong?
Well, they have a vast and incredibly valuable IP portfolio. We're talking about iconic characters, franchises, stories, from the classics like Mickey Mouse to the powerhouses like Marvel and Star Wars, the heartwarming stories of Pixar. This IP gives them an endless stream of content and opportunities to create new products and experiences across their entire business.
Yeah, it's like a treasure trove of stories and characters that they can draw from.
Right, exactly. And then another key strength is their diversified business model. Operating in entertainment, sports, experiences, it gives them multiple revenue streams and reduces their risk. If one area is struggling, the others can help to offset that.
Makes sense. That diversification definitely adds a layer of stability to their overall business.
Absolutely. And then, they're really good at what they do. They have successful content creation capabilities. They've got a long track record of producing high quality, engaging content, whether it's movies, TV shows, or now streaming series. They know how to tell stories that resonate with audiences around the world.
They've mastered the art of storytelling on a global scale.
Right. And they have the reach to deliver those stories. They've got a global reach and distribution network. Their content and experiences are available all over the world. And then the final strength I would highlight is the synergy between their different segments. They're really good at integrating their IP and content across their different business areas, creating this powerful ecosystem where, a movie can lead to park attendance, which can lead to merchandise sales, and so on.
It all works together.
Yeah.
Okay, so we've covered their strengths. Now what about their weaknesses? Where might they be more vulnerable?
Well, where their main weaknesses, and we talked about this earlier, is the decline in their linear networks business. Cord cutting is a real challenge for traditional cable channels, and it's something they're going to have to continue to navigate.
Yeah, it's an industry-wide trend, but given how big their linear business is it's definitely a significant headwind for them.
Another weakness is the high cost of content creation. Producing all these amazing movies and shows for streaming, it's expensive, and it can put a strain on profitability, especially in the short term.
It's like an arms race in the streaming world. Everyone's trying to have the best content.
Exactly. And then their sensitivity to economic downturns is another potential weakness. The experiences segment with the parks and cruises, that tends to be more vulnerable when the economy slows down and people are spending less on discretionary items.
Yeah, it's easy to cut back on those big vacation expenses when money's tight.
And then, of course, the streaming market itself is incredibly competitive. There are so many players out there all fighting for subscribers. And finally, there's always the potential for brand dilution. If they oversaturate the market with their IP or they don't manage their franchises carefully, they could risk weakening the brand.
It's a delicate balance.
Yeah.
Too much of a good thing can sometimes be a bad thing. All right, let's move on to opportunities. Where are the big growth areas for Disney?
Well, they have a lot of opportunities. Continued growth in their streaming services is huge. There's still a lot of room to grow, both domestically and internationally, especially in markets where they're just starting to launch Disney Plus and Hulu.
Yeah, I mean, there's a whole global audience out there waiting to be tapped.
Right. And then international expansion more broadly across all their segments is another big opportunity. Not just streaming, but theme parks, merchandise, everything.
It seems like there's no shortage of people around the world who are interested in Disney.
And then technology presents a lot of exciting opportunities. They can leverage technology to enhance the guest experience at their parks, create new forms of entertainment, improve their distribution methods. I mean, the possibilities are endless.
Yeah, you can imagine how things like augmented reality and virtual reality could really transform their business.
And then strategic partnerships and collaborations are another big opportunity. Teaming up with other companies can give them access to new markets, new technologies, new content. It's a really smart way to grow.
Yeah, and then you have merchandise and licensing, leveraging their IP to create new products and expand their reach through retail partnerships. And then, of course, they've talked about investing more in their parks and experiences, which is always a good sign.
So it sounds like they have a lot of exciting avenues for growth.
They do. But what about threats? What are the things that could potentially hinder their progress?
Well, competition is always a threat. It's getting more and more intense across all their business segments, so they have to constantly be innovating and adapting to stay ahead of the curve.
Yeah, the entertainment and media landscape is constantly changing.
And consumer preferences are changing too. People's tastes and how they consume content are constantly evolving, so Disney has to be able to adapt to those shifts.
It's hard to predict what's going to be popular next year, let alone 5 years from now.
And then economic recessions, that's always a threat. We talked about how it can impact the experiences segment, but it can also affect advertising revenue and just overall consumer spending. So that's something they have to keep an eye on.
Yeah, that's a big one. And then you have the ongoing threat of cord cutting, which is hurting their linear networks business. Piracy is still a problem for content creators. And then, operating in so many different countries, they have to deal with geopolitical and regulatory risks, which can be unpredictable.
It's a complex world out there.
It is. Okay, let's dive into some of the specific questions we wanted to address. First up, how exactly does Disney make money? We talked about their different segments, but what are the actual revenue streams within each one?
Okay, so within the entertainment segment, you've got the linear networks, which are primarily making money through those affiliate fees from cable and satellite providers, as well as advertising revenue. Then you have the direct-to-consumer segment, where the main source of income is subscription fees from Disney Plus, Hulu, and ESPN Plus Note, and they're also starting to experiment with advertising on some of those platforms. And then content sales, licensing, and other, that's where they're making money from licensing their IP, from theatrical releases of their movies, and from home entertainment sales and rentals.
All right, so that breaks down the entertainment revenue streams. What about sports?
For sports, it's pretty similar to the linear networks. They rely heavily on affiliate fees from those cable and satellite providers. And then they also make money from advertising, especially during those live sports broadcasts. And then, of course, ESPN Plus is generating revenue through subscriptions.
And last but not least, how does the experiences segment generate revenue?
So the experiences segment has a few different buckets. Theme parks and resorts, their biggest moneymaker there is ticket sales, but they also make a lot of money from all the spending that happens once people are inside the parks, food, drinks, merchandise, all that. The Disney Cruise Line, it's the cruise fares and the onboard purchases. Merchandise, they're designing, sourcing, and selling all sorts of Disney-branded products. And then licensing, they're licensing their characters and brands to other companies who want to use them on their products.
So a lot of different ways to make money in that segment. Now, here's the big question. Is Disney a good business? Based on everything we've discussed, what's your assessment?
Well, defining a good business is kind of subjective. But there are a few key things to consider. You look at profitability, brand strength, customer loyalty, competitive advantages, and the ability to adapt to a changing market. And when you look at Disney through that lens, I think there's a strong case to be made that they are a good business. I mean, the recent increases in their operating income, that's definitely a positive sign. They have an incredibly strong brand, a massive and loyal customer base that's really emotionally connected to their stories and characters, and they're building these recurring revenue streams with their streaming services. There are definitely challenges, like we talked about with the decline in their linear networks business and the competitive streaming landscape. But overall, I think the strength of their brand and the positive trends they're seeing suggest a company with a lot of long-term potential.
So some headwinds, but overall, the outlook seems pretty bright. Another question I had was, how often do Disney's customers actually buy from them or engage with their products and services?
Well, it really depends on the specific product or service. For their streaming services, it's usually a monthly or annual subscription, and the idea is to keep people engaged with a constant flow of new content. Theme parks and resorts, those are typically less frequent purchases. People might go once a year for a family vacation or for a special occasion, but once they're there, they might be spending money on a daily basis on things like food, drinks, and souvenirs. Merchandise, that's completely dependent on the individual. Some people buy Disney stuff all the time. Others might only buy something once in a while. And then for the linear networks, it's a monthly subscription to a cable or satellite package, even though people might be watching those channels every day.
Makes sense. You're probably streaming something every day, but you're not going to Disney World every day. What about their ability to raise prices? Do they have much pricing power?
Well, they definitely have some pricing power, especially in their theme parks and resorts. They offer these unique and highly sought-after experiences, and people have such a strong emotional connection to the brand. They're often willing to pay a premium. They have a history of successfully raising prices in those areas. But, there are limits to how much they can charge, especially in a competitive market like streaming where there are so many options for consumers. ESPN has historically had a lot of pricing power with their affiliate fees because live sports are so valuable to cable providers, but even that can be challenged. Ultimately, Disney has to be strategic about how they raise prices, making sure they're not alienating their customer base.
It's all about finding that sweet spot. Now, how do you think a company like Disney would fare in an economic recession?
I think the experiences segment would probably be hit the hardest. When the economy slows down and people have less money, they tend to cut back on things like vacations and entertainment, so the parks and cruises would likely see a drop in attendance. But their entertainment segment, particularly the streaming services, might actually do okay. During a recession, people often look for more affordable ways to entertain themselves at home, so streaming services like Disney Plus and Hulu could actually see an increase in subscribers. And then, Disney has such a strong brand, there's a good chance that people will still prioritize their products and services even when they're trying to save money.
So a recession could actually benefit some parts of their business. Now, who are Disney's customers? Is it a wide range, or are they more focused on specific demographics?
They have a really broad and diverse customer base. I mean, it spans all ages, all income levels, all over the world. Families are a huge part of their audience, especially for things like the theme parks, movies, and merchandise. But their streaming services appeal to a wider audience, including people who are just big fans of their specific franchises, like Marvel or Star Wars. ESPN, of course, caters to sports fans. But the key takeaway here is that they have a truly global customer base, which reduces their reliance on any one market or demographic.
So a truly global entertainment company. In a nutshell, what would you say are their key products and services?
So for entertainment, it's the movies, TV shows, streaming services, linear networks, and content licensing. For sports, it's basically ESPN, their cable networks, ESPN Plus, and all the live and on-demand sports programming that comes with that. And then for experiences, it's the theme parks, the cruise line, merchandise, licensing, and live entertainment.
Content, access to content, and those immersive experiences. And geographically, where do they operate?
pretty much everywhere. They have theme parks in North America, Europe, and Asia. Their media networks and streaming services are global, and they have corporate offices, studios, and partners all over the world.
All right, now let's talk about their economic moat. For those who aren't familiar with the term, it refers to a company's sustainable competitive advantage.
Yeah.
So what are the key moats that Disney has?
I would say their biggest moat is their brand identity. It's just so powerful, so recognizable, and it evokes such strong positive emotions in people. It's something that's taken them decades to build, and it's really hard to replicate.
It's like a shorthand for quality and entertainment.
Exactly. And then you have their IP, their intellectual property. I mean, they own some of the most beloved and recognizable characters and stories in the world. And that's a huge advantage because they can use that IP to create new content, new products, new experiences, and it's a constant source of value for them.
It's like an endless well of inspiration.
And then the third moat I would highlight is their network effects in streaming. The more subscribers they get on Disney Plus and Hulu, the more valuable those platforms become, and that allows them to invest in even more content, which attracts even more subscribers, and so on. It's a positive feedback loop.
It's the strength of their brand, the depth of their IP, and the network effects in streaming. Those are their key moats. Do you think their moat is widening or narrowing?
I think it's probably widening. They keep investing in high-quality original content for their streaming services, which makes them more attractive to subscribers. They're really good at leveraging their IP across all their businesses, especially in the parks and experiences, and that creates a unique and compelling offering that's hard to compete with. And then, acquisitions like Hulu help to solidify their position in the streaming market. So overall, I think they're doing a good job of reinforcing their competitive advantages.
All right, so looking ahead, what are the biggest growth opportunities for Disney?
I think the biggest opportunity is continued growth in streaming, both domestically and internationally. They're also well-positioned to expand their presence in international markets across all their segments. Technology, as we talked about before, presents a lot of exciting opportunities to create new forms of entertainment and enhance their existing offerings. Strategic partnerships and acquisitions can help them grow more quickly and enter new markets. And then, continued investment in their parks and experiences division is a smart move, considering how successful that segment has been.
It sounds like they have a lot of different ways to grow. Finally, we've seen some interesting news about their recent acquisitions and strategic investments. What do you make of those moves? Do you think they're trying to enter new markets?
Yeah, it's definitely worth noting those moves. The full acquisition of Hulu was a big one. It gives them complete control over that platform and allows them to offer a more integrated streaming experience with Disney Plus costs. So that's about consolidating their position in the existing streaming market. Then you have the investment in Epic Games, which is really interesting because it suggests that they're thinking about the future of entertainment, the metaverse, interactive gaming. It's a different space for them. And then the proposed acquisition of Fubo TV, that's all about strengthening their position in the streaming and sports programming market, and it could help them reach a different segment of consumers. So overall, I think these moves show that they're not content with just staying in their lane. They're looking for new ways to grow and evolve.
It's clear that they're trying to shape the future of entertainment. And I thought this would be really interesting because so many people are interested in Disney stock. Disney as a company.
Mm-hmm. Absolutely.
People follow it closely.
Mm-hmm.
And, but I think a lot of the listeners are probably amateur investors. So we're going to try to explain everything as clearly as possible and try to make it so everybody can understand
For sure.
exactly how these financials work.
Yeah.
Now, we're going to be looking at their most recent fiscal year, which was 2024.
Yeah.
And that ended September 28th, 2024.
Okay.
And then we'll also be looking at the first quarter of 2025, which ended December 28th.
Right.
So we got some pretty up-to-date info, which is exciting. Now, I guess before we get into the nitty-gritty, maybe we should talk a little about what a fiscal year is.
Yeah, that's a great point, because not everybody understands that, Disney's fiscal year isn't the same as, the calendar year, January through December, right?
Right.
So when we say 2024, their fiscal year actually ended on September 28th, 2024. So it's kind of like October 23 to September 24, that period.
Gotcha.
So yeah, keep that in mind as we go through this.
So really we're going to be comparing October 23 to September 24 with the year before that. And same with the quarters, right?
Exactly, yeah. We're looking at those specific chunks of time.
Okay, cool. So let's jump into it then. Why don't we start with the big picture? What was the overall message in their executive summary? How did they say they did?
Well, the first thing that jumped out at me is they were talking about, they've really improved their profitability, and a lot of that was being driven by the direct-to-consumer segment, which is like your Disney Plus affair, your Hulu, that kind of stuff. So they're saying, hey, streaming's really working out for us, right? Which is, good to see.
That's good news.
Yeah, for investors, that's good news. And they also talked about, some strategic transactions they've been making, for example, a joint venture that they have with Star India. So, it's not just about the numbers, it's about how they're strategically positioning themselves, which I think is really interesting to look at.
Yeah, absolutely. And I think when we look at those specific things, it really tells you where they see the future of the company going, right? Like if they're making certain moves, selling off certain parts, keeping other parts, that kind of tells you what they think is going to work in the long run.
Yeah, exactly. Like what they're betting on, basically.
Exactly.
Yeah.
Okay, so big picture, they seem to be doing pretty well.
Yeah.
Increased profitability, which is always good news. Now, let's get into like the specific financial metrics that we should be paying attention to when we're looking at Disney's performance.
Okay, yeah. So I think a good place to start for anybody, if you're kind of new to this, is with their revenue. And that's just basically the money they brought in. But it's even better to look at how that revenue is divided between their different operating segments, which are basically their different main businesses.
Okay.
And for Disney, those are entertainment, sports, and experiences.
Okay, so that kind of gives you a breakdown of where the money's actually coming from so you can get a feel for what are the most important parts of the business, really?
Exactly. Like how much is each part contributing?
Yeah, exactly. So let's start with entertainment. What exactly falls under the entertainment segment?
So entertainment is pretty broad, and it includes what they call linear networks, which are basically your traditional TV channels.
Right.
And they have those both domestically, your ABCs, Disney channels, and then international channels as well. And then it also includes, of course, their direct-to-consumer, which we talked about. So your Disney Plus Hotstar, and Hulu.
Right.
And then they also have content sales and licensing. And that's basically when they sell or license their movies and shows to other companies or platforms.
Yeah.
So, if you see a Disney movie on, like, I don't know, Netflix, that's probably them licensing it out.
Okay. And I imagine they're making money in this segment in several ways, right?
Yeah, so they're getting subscription fees from the streaming services, advertising both on their traditional TV channels and on streaming, and then affiliate fees. Now, affiliate fees are basically what cable and satellite companies pay them to carry their channels.
Gotcha.
So that's still a big source of revenue for, these networks.
Makes sense. Okay, so looking at their fiscal year 2024,
Yeah.
how did the entertainment segment do overall?
So their revenue went up a little bit, about 1%, from $40.635 billion in 2023 to $41.186 billion in 2024.
Okay.
But the bigger story, I think, is their operating income. And that increased by way more than 100%, from $1.444 billion to $3.923 billion.
Wow, that's a huge jump.
Yeah, that's significant. And that suggests that, they're getting a lot more efficient at managing their costs in that part of the business.
Maybe because the revenue only went up 1%.
Yeah.
But the actual profit went up tremendously.
Exactly. So something's working well there.
Yeah. So what do you think, what are some of the factors that might have led to that increase in operating income?
I think it could be a few things, right? It could be they're spending a little less in some areas of content creation. It could be they're just finding more ways to monetize the content that they have.
Oh.
It could also be that, their direct-to-consumer efforts are really starting to become more profitable.
Gotcha.
Yeah.
So they're kind of fine-tuning things, figuring out what works, and it seems to be paying off.
Yeah, definitely.
Now, you mentioned direct-to-consumer. Let's talk about Disney Plus and Hulu specifically.
Yeah.
Like, what are we seeing in terms of subscriber numbers?
Right. So when we look at direct-to-consumer, they reached 178 million subscribers between Disney Plus and Hulu.
Okay.
That's an increase of 0.9 million compared to the previous quarter.
Okay.
It doesn't give us a full year-over-year comparison in this particular excerpt, but it is still, adding subscribers, which is a good sign in this very competitive streaming landscape.
Yeah, especially as a lot of Oppurtunities are actually losing subscribers.
Exactly. So they're holding their own, which is good.
Yeah, that's good news. It's also interesting to see that their linear networks like A&E, History, and Lifetime, they still have 58 million domestic subscribers each.
Right. Yeah.
That's still a lot of people.
Yeah. It shows the power of, traditional TV still, I guess.
Exactly. Yeah. All right. So entertainment seems to be doing well.
Yeah.
Let's move on to sports. Now, what all falls under their sports segment?
So sports is primarily ESPN.
Okay.
And that includes their, 7 ESPN branded television channels that we have here in the US.
Right.
ESPN on ABC, which is basically sports programmed on ABC by ESPN. And then, of course, the ESPN Plus direct-to-consumer service.
Gotcha. So how do they make money in this segment?
So it's a lot of the same things as entertainment, affiliate fees
Yeah.
from cable and satellite companies, advertising revenue on their channels and on ESPN Plus,
Okay.
subscription fees, of course, for ESPN Plus.
Okay.
And then they have other revenue, which can be things like, pay-per-view events or licensing out some of their sports rights to other broadcasters.
Okay. So looking at fiscal year 2024, how did the sports segment do?
So their revenue actually increased by 3%. Going from $17.111 billion to $17.619 billion.
Okay.
But their operating income actually decreased slightly, about 2%, from $2.465 billion to $2.406 billion.
Okay. So opposite of entertainment. Entertainment went up a lot. This went down a little bit.
Yeah, exactly.
Even though revenue still went up.
Right.
Yeah.
Interesting. Yeah. And that could be, potentially because of the rising cost of sports rights.
Right.
These deals are getting very, very expensive.
They are huge. Yeah.
So even though they're bringing in more money,
Right.
the profits might be squeezed if those costs are going up faster.
Yeah. Absolutely. Makes sense. All right. So let's move on to the fun one. Experiences.
Yes, the fun one.
This is the theme parks, right?
Exactly. So theme park admissions, resorts and vacations, all the merchandise, food and beverage they sell in the parks.
Okay.
And then also merchandise licensing and retail outside of the parks.
Gotcha. So how did this segment perform in 2024?
So they had some pretty solid growth. Revenue increased by 5%, going from $32.549 billion to $34.151 billion.
Okay.
And operating income increased as well, 4%, from $8.954 billion to $9.272 billion.
Okay.
And, there's still strong demand for Disney parks.
Yeah, absolutely.
It's also worth noting the Shanghai Disneyland opened its new Zootopia-themed area in December 2023.
I saw that.
Yeah, so that probably helped boost performance, especially for the international parks.
Yeah, definitely.
And just as a reminder, they own a 43% interest in the Shanghai Disney Resort.
Right. Okay, so experiences seems to be doing really well.
Yeah.
Strong growth. Okay, so we've gone through each of the segments individually. Now let's take a step back and look at the total financials for the entire company.
Okay.
Comparing 2024 to 2023. What were like the overall, big numbers?
All right, so overall, revenue increased by 3%.
Okay.
Going from $88.898 billion in 2023 to $91.361 billion in 2024.
Okay, not bad.
Yeah, and even more impressive, their income from continuing operations before income taxes increased by 59%, from $4.769 billion to $7.569 billion.
So that's that big jump in profitability that we talked about in the beginning.
Exactly, yeah. So this is kind of, really showing that the underlying health of the business is improving.
Okay, good news. Now, what about taxes? Like, how much did they end up paying in taxes?
So their effective income tax rate actually decreased from 28.9% in 2023 to 23.7% in 2024. And they mentioned this was partly due to a $418 million benefit related to, tax matters from prior years and a lower foreign effective tax rate. But, some of that was offset by higher non-tax deductible impairments. So
Right.
lots of moving parts there.
Okay, and then what about other income and expenses, like things that aren't directly related to their core business operations?
Yeah, so there's always kind of, little things that pop up.
Right.
So in fiscal 2023, they had a gain of $169 million on their investment in DraftKings, which they sold in 2023. So that was, kind of a one-time thing that added to their other income in 2023. Their interest expense, which is basically the cost of borrowing money, increased from $1.209 billion to $1.260 billion. Their restructuring and impairment charges, those decreased from $3.836 billion to $3.595 billion. And similarly, the TFCF and Hulu acquisition amortization, that also decreased from $1.998 billion to $1.677 billion.
Okay, and amortization, just to clarify for anybody who's not familiar, that's basically spreading out the cost of an asset over its useful life.
Exactly. So like when they bought TFCF and Hulu, there were certain assets that, they're kind of gradually writing off the value of those assets over time.
Gotcha. Okay, so a lot of moving parts, but the big picture is that they're still doing pretty well.
Yeah, for sure.
All right, now let's move on to something a little different. The 10K report also talks about their employees and what they call human capital management. So what can we learn about how Disney manages their workforce from these reports?
Well, they say that their benefits are designed to meet the varied and evolving needs of their, diverse workforce and their families.
Okay.
So they offer a wide range of benefits, health, financial, family resources, well-being benefits.
Okay.
And, for investors, this is important because a company that takes care of its employees is probably going to be better at attracting and retaining talent,
Right. Absolutely.
which ultimately can lead to, better performance for the business.
Yeah. Happy employees, happy customers.
Right, exactly.
Happy shareholders. Now, every 10K also has a section on risk factors, which is, I think, one of the most important sections to read because it kind of tells you what could go wrong.
Absolutely, yeah.
So what were some of the key risks that Disney highlighted?
So there's a lot of risks. There always are, right? But some of the ones they highlighted, a lot of them were related to their streaming services.
Right.
Competition, the willingness of consumers to pay for multiple streaming services,
Right.
government regulation of the media.
Oh.
All these things can impact streaming.
Yeah.
They also talked about potential credit rating actions, interest rate increases,
Okay.
financial market volatility. So basically anything that could affect their ability to borrow money and finance their operations.
Gotcha. And I think, especially with interest rates going up so much lately,
Yeah,
it's definitely a big concern for a lot of companies, right?
absolutely. Yeah.
All right. What else? What are the risks?
They talked about labor disputes. We had the writers and actors strikes last year,
Right.
how those could impact productions and costs.
Yeah, that's a big one.
Yeah. Protecting intellectual property, always a concern.
Especially with the rise of AI now, I imagine.
Absolutely. Yeah. And, piracy, unauthorized use, all those things.
Yeah.
They also mentioned a cybersecurity incident where a large amount of their data was accessed and released without permission.
Ooh, that's not good.
No, not good. So, cybersecurity is definitely a big concern for them as well.
For everybody, really.
Yeah, pretty much.
Okay. Now, were there any specific legal matters that they disclosed in the report?
Yeah, they mentioned that they had entered into a confidential arbitration with NBCU.
Oh, okay.
And that's basically, a private legal process to resolve a dispute.
Right.
And this particular dispute was over how to determine the fair value of NBCU's stake in Hulu.
Okay. Interesting.
Yeah. So, these legal matters can sometimes have a big impact on a company's finances down the road, so it's something to keep an eye on.
Yeah, definitely. Okay, let's talk about debt. What's Disney's current debt situation and how have they been borrowing money?
Okay, so as of September 28th, 2024, their long-term debt was rated A2 by Moody's, A by S&P, and A by Fitch,
Right.
all with either stable or positive outlook. So, these are good ratings.
Yeah, that's solid.
It means they're considered a relatively safe borrower. Their bank facilities, they actually only have one financial covenant,
Okay.
and that's related to interest coverage.
Huh.
So basically making sure they have enough earnings to cover their interest payments,
Gotcha.
which they were meeting comfortably. They've also provided loans to the Shanghai Disney Resort,
Okay.
totaling $961 million at an interest rate of 8%. And those loans are scheduled to mature in 2036, but they can make early payments based on available cash flows.
Okay, interesting. So it sounds like they're being pretty responsible with their debt.
Yeah, it seems manageable.
All right, what about cash flow? What do we see there?
So when we look at their commercial paper activity, which is basically short-term borrowing for large companies,
Okay.
the amount outstanding at the end of fiscal year 2024 was $2.65 billion, which is an increase from the $1.476 billion at the end of fiscal year 2023. So, a bit of an increase in short-term borrowing. But, it's important to consider this within the context of their overall financial health and their ability to generate cash from their operations.
Right. If they're making plenty of money, then borrowing a little bit more isn't necessarily a bad thing.
Exactly.
Yeah. Okay. Another term we often see in financial reports is goodwill impairment. Now, what happened with that for Disney in 2024?
Okay, so goodwill impairment. Goodwill basically represents the value of things like brand name, customer relationships that a company acquires when they buy another business.
Gotcha.
And if the value of those intangible assets goes down, they might have to take a goodwill impairment charge,
Okay.
which is basically saying, hey, maybe we overpaid for this
Right.
a little bit.
Yeah.
So in 2024, they had non-cash goodwill impairment charges of $0.7 billion in Q2 and $0.6 billion in Q4.
Okay.
And that was related to their entertainment linear networks. So,
Right.
reassessing the value of some of those traditional TV assets.
Gotcha.
Yeah.
Did they have any goodwill impairment related to their streaming services?
They specifically said that there was no goodwill impairment at their direct-to-consumer streaming services.
Okay, interesting. All right, so that gives us a pretty good look back at fiscal year 2024.
Yeah.
Now, let's turn our attention to their most recent first quarter of 2025,
Okay.
which ended in December 2024. What were some of the key financial results from that quarter?
So for that quarter, they reported a net income of $2.644 billion.
Okay.
And their depreciation and amortization expense was $1.276 billion.
Okay.
And these are important because they kind of give us a sense of the ongoing profitability and how quickly their assets are being used up.
Right. Depreciation is for physical assets.
Yeah.
Amortization is for intangible assets like we talked about before.
Exactly.
Okay, cool. And they also did some stock buybacks, right?
Yeah, so they have a share repurchase program that they implemented back in February 2024.
Okay.
Authorizing them to repurchase up to 400 million shares. And from September 29th, 2024 to December 28th, 2024, they bought back 7,198,000 shares.
Okay, and just to explain what stock buybacks are for anybody who's not familiar,
Yeah.
basically the company is using its own money to buy back its own stock.
Mm-hmm.
And what that does is it reduces the number of shares outstanding,
Right.
which can increase the earnings per share
Yeah,
and therefore the value of each individual share.
exactly.
So it's often seen as a way to return value to shareholders.
Yeah, it's a way to boost the stock price. Basically.
Exactly.
I-
Okay, let's finish up by talking about their earnings calls. These are the calls where the CEO and CFO talk to analysts and investors,
Right.
and they give more color on the results and maybe their outlook for the future. So what were some of the interesting things that came out of their recent earnings calls?
Okay, so Bob Iger, the CEO, he was very excited about some of the upcoming movie releases, like
Yeah.
Moana 2 and Mufasa.
Sequels always do well.
Yeah, they usually do pretty well. He also highlighted the strong performance of ESPN, saying that April was fantastic for them in terms of viewership.
Okay.
And he specifically mentioned that an NFL game between the Texans and Ravens was their most watched NFL game ever,
Wow.
with 32.4 million viewers.
Huge.
Yeah, that's a lot of people. They also talked about their plans for an ESPN tile on Disney Plus,
Okay.
which is meant to increase engagement.
Okay.
And they were also very happy about all the long-term deals they've locked up with major sports organizations.
Okay.
College football championships, all the NCAA championships, the
Yeah.
NFL. They're also working on a long-term deal with the NBA, hoping to secure that.
Okay. So they're really doubling down on sports.
Yeah, definitely. It's clearly a big part of their strategy.
Yeah, especially with ESPN Plus Gals, right?
Absolutely.
Okay. So to bring it all together, what are the main takeaways our listeners should keep in mind after this deep dive into Disney's financials?
So the key takeaways are their profitability has improved significantly.
That's being driven by their streaming business, their theme parks. Those are doing really well.
Right.
The sports segment, a little bit of a dip in profit, but revenue is still growing.
Okay.
And they're securing those important sports rights.
Right.
So they're actively managing their costs. They're making strategic moves.
Right.
And they're returning value to shareholders through stock buybacks.
Okay.
And they're operating in a very competitive market. And they're addressing those challenges
Yeah.
and continuing to invest in new content and experiences.
Right. So basically a mixed bag, but overall a pretty positive picture.
Yeah, I'd say so.
Okay, cool. So as a final thought, think about this. How is Disney balancing those traditional strengths that they have, the movies, the theme parks, with their newer ventures in streaming? And how might that strategy need to change, as people's viewing habits evolve, as technology changes? So it's a really interesting time. A lot of changes happening.
For sure.
But Disney seems to be adapting pretty well. Yeah, I'd agree.
All right, so that's our deep dive on Disney.
Oh, if you enjoyed it.
Yeah. And if you found this helpful, please like and subscribe to The Four Quarters and attend